Good morning. Welcome to the morning market briefing. Today is Tuesday, May 5th, 2026. And word on the street is there's a mini war on. So the news this morning, and there's a press conference ongoing, and we'll touch on some of the things that have been said so far, which are exciting to report on for me. So Project Freedom, which we talked about on yesterday's call, which was a coordinated effort for the U.S. to start allowing trapped commercial ships to navigate the Strait of Hormuz. Though the initial report in the Wall Street Journal said that there would be no U.S. Navy vessel involvement, it seems that there actually was. So yesterday we saw some commercial ships and some U.S. Navy ships navigate the Strait of Hormuz, and they were fired upon by cruise missiles from shore, as well as the quote-unquote Iranian Mosquito Navy, which is a harassment detail of speedboats that come out and try and attack quickly and surround ships to, I guess, scuttle them. I'm not exactly sure what you would do with the Mosquito Navy other than just scare people into turning around. And the result was that the missiles were neutralized, and a swarm of Apache helicopters were waiting in case something did happen, and they essentially sank the Mosquito Navy and quickly eliminated the threat, and a handful of vessels went through the strait. And technically speaking, the ceasefire was broken, and that Trump has been open about saying that he's willing to look past it, he's still looking to make a deal, and that there was a mini war, but that everything is moving along nicely. Those are sort of the takeaways. Sorry, this is a tough pod, but I've got to clear my throat. Hold. Okay, we're back. Basically, now there's a current press conference going on with Pete Hegseth and General Raising Cane, where they're talking about the current situation and whether or not the ceasefire is broken. And they basically have said this is a separate operation. This is about international waters and free trade globally, and that this is more of a security mission and not a direct break of the ceasefire, which is, listen, if they're choosing for it not to be a reason to drop more bombs, then that's what they're choosing. But I would say the notable takeaway is that Pete Hegseth was questioned as to whether or not they were encountering kamikaze dolphins with mines attached to them that the Iranians have reportedly been, I guess, releasing into the Strait of Hormuz. And his response was pretty awesome, which is that he can't confirm or deny that we have kamikaze dolphins, but he can confirm that the Iranian Navy does not. So that's where we are right now. We've gotten to the point where now kamikaze dolphins are a real thing that people are talking about at the highest levels of government. So I would expect this to continue to be just an absolute mess for some period of time, whether it's 3 weeks or 3 months or 3 years. I guess we'll find out. But for the most part, the markets are showing signs of positivity. We've got futures up, call it between 40 and 60 basis points. And I think a lot of that has to do with the fact that the war has not kicked back off, so people are kind of business as usual. And we actually have a couple of notable stocks reporting this morning that have done very well as a result of the war. So I don't know if that's a good thing or a bad thing, but money is certainly being made on it, even if it's not necessarily from global shipping revenues. Touching on a couple of things that we talked about yesterday, we talked about how GameStop, call it $11-12 billion company, is looking to purchase eBay, which is a $56 billion company. And Ryan Cohen, the CEO of GameStop and the former founder of actually Chewy.com, the pet food by mail company, had one of the most unusual interviews I've ever seen on CNBC. It was with Andrew Ross Sorkin, and hand up, I was not familiar with Ryan Cohen's game before this interview. But, I mean, first of all, we have to talk about his appearance, which is that he's definitely doing something, and I'm not sure what it is. It definitely involves a lot of Botox and potentially some sort of, maybe a facelift. The guy's got real smooth skin, real rosy cheeks, and his hairline starts about, I would say, perpendicular, or I guess in line with his ears. So hair's not real. It starts in a weird spot. Face isn't real. It's real shiny, and he's got real rosy cheeks. And so the dichotomy of him just on a Zoom call with a blurry background, not a lot of production value with Andrew Ross Sorkin. So the starkness of that is really where it starts. And then Andrew Ross Sorkin is like, hey, this is a pretty unusual deal. You've got a very small company trying to buy a very big company. Can you walk us through the details of that? And his response was, and I quote, "It's on our website. It's half cash and half stock." And then Andrew Ross Sorkin continues to kind of be like, yeah, I get that, but you don't have that much cash. You don't have that much stock. And the amount of money that's guaranteed, or at least strongly suggested that TD Bank is going to ante up to make this deal go through, you're still coming back $16 billion short. And his response was basically, all right, man, well, I guess we'll see what happens. And it's peak cringe television. It's almost like something out of Curb Your Enthusiasm. I mean, the guy is not giving an inch. He is not interested in being on TV. He's not selling the deal in any way. He's basically just big dogging Andrew Ross Sorkin, who we all know is a weenie to begin with, and is really struggling to get it going through. But after I saw it, I was like, so what's in it for Ryan Cohen? Why is he doing this, and why is he acting this way? So I went and looked to see exactly how he is compensated as CEO of GameStop. And he came in with a couple other Chewy execs during the meme stock, explosion of GameStop, and has sort of taken the bull by the horns and turned them into a company that at least is profitable and growing, and not circling the drain like they were before, the internet basically saved them from bankruptcy. And it's really interesting, and it makes me kind of excited about this deal and want to keep watching it. So he gets no salary, no cash compensation of any kind. He doesn't get any stock grants every year. His compensation is 100% based on a massive stock award if he gets the value of the company to $35 billion, which is more than 3 times what it's worth right now. And then the only other piece is that if he gets the market cap to $100 billion and gets $10 billion of annual EBITDA, he then gets another massive stock grant, at which point he will probably be compensated in the, somewhere in the range of, call it $5 to $10 billion in stock. And so he's already worth, they say, $5 to $5.5 billion from selling Chewy, and he is a billionaire. And it doesn't seem like he's real interested in, making, I don't know, $3 or $4 million or $10 million that a CEO would make for a company of this size. He's just in it to grow this thing as big as possible so he can make another just massive payout and, be worth, call it $10 to $15 billion. So I think that's a really interesting thing. And when we look at stocks internally, and, this is probably more Ben's area, but that's something we look at is, how are the key people compensated? Because there are a lot of companies where, they only have to get certain metrics over very low hurdles, and then the CEO makes just a massive payout of money in stock, and it's not real hard to do. And so they're not real incentivized to be like, how do we cut costs? How do we do this? It's like, oh, we got to get free cash flow to X number of dollars, and I'm going to get a huge payout. And so this makes this deal very interesting because he wants to make this deal go through because he will instantly pick up, call it $1 billion. He's going to make a ton of money if that happens because he'll easily clear the hurdle of $35 billion if they suddenly become a $56 billion company. So I would be watching this closely because I think incentives are a real thing. They're probably the most powerful thing in markets, and this guy really wants to do this. And so I sort of think he might actually get it done. So I don't know. I think it's a weird, quirky story. I think that they have been, that's the hook, I think, is that this guy's very interested in doing this because of the way he's compensated. I don't think the hook is GameStop, they're a meme company, they're going to take over the world, Reddit dorks everywhere are looking to buy it. I think that, like, the true interesting piece is, like, there's a guy out here who could make a ton of money. He wants to make a ton of money. And in fact, it's the only money he'll make off his job is if he does something extraordinary with what was once a very less than ordinary company. So food for thought, something to consider when watching the news on this, because I think it's just fascinating. We got a lot of earnings this morning. Not a lot of companies we own. The biggest one that we own that reported earnings is BWXT is the ticker, which is BWX Technology. They're a company that makes the nuclear units on nuclear subs. They've become a very hot company due to the massive power needs of AI. They also have a weird side business it's sort of accidental, but one of the, I guess, waste chemicals off of what they do is a rare form of an isotope of molybdenum, which is a rare earth metal that goes into all kinds of stuff, including your iPhone. But this particular isotope is great for cancer treatments. It's like nanoparticles that they inject into tumors. So they're simultaneously a nuclear sub power unit / nuclear isotope medical company. They've done fantastic, and they've been very strong this year and last year, and the stock price, I would say, is pretty elevated. They're flat after earnings, but another just banner year for them. So they were up 26% year over year on revenue, beating estimates by, call it $33 million. EPS, they beat. Expectation was 92 cents per share. They made $1.12. Their backlog is up 77% to $8.7 billion, and they raised full year guidance. So it's a little disappointing. The stock probably doesn't need to be up. It's already been up. It's been just an unbelievable performer for us, but the stock is flat. In a similar vein, Palantir, which you may recall from listening to the podcast, is an ontology company, which is the study of existence, or the nature of being is what they call each other. But I would say that they're more of like an AI subterfuge and spy company, I guess. No one really knows what they do because they work for the government, and a lot of people are saying they led to the, helping blow up all the beepers in Lebanon with Israel, and that they may be helping with all of the crazy simultaneous targeting and knowing where everyone is and tracking all of the Iranian heads of state that, are no longer living. So they just crushed it. They had $163 billion in revenue, which is up 85% year over year, which was, $100 million over the estimate. Revenue was up 104% year over year on the U.S. government. So suffice it to say, the war in Iran is good for business. They beat on EPS. Operating margins were 60%. They've got $1 billion roughly in free cash flow, and they raised full year guidance, up to 7.65 to 7.66 billion, which would be 71% year over year growth if they hit that target. So just crushing. And they're actually down, and that's another one. They've just been on fire the last 3-4 years. I mean, they're one of the hottest, names in the market, and they're very tough to value because we don't know what they do, and a lot of their contracts are not public, but they've done very well. But the stock is down on earnings because expectations clearly were high for both these companies. Everybody expected them to do well as a result of the war, and I think that there's not a lot of massive surprise upside there. But I would equate that to Chevron and Exxon reporting last week. Surprise, surprise, they made a ton of money because oil prices are up, but the stock didn't exactly zoom, but that's because they were already up 40% for the year. In other earnings news, Coinbase reported they're laying off 14% of their staff, citing volatile crypto markets and AI. I think we're going to continue to see this trend, but they basically said, hey, we're going to focus all our efforts around the staff that is most highly attuned to getting AI to do other tasks, and they're just going to eliminate a bunch of middle management. And we've seen that already with another few companies. I think we'll continue to see that. We don't own Coinbase, and we don't own Bitcoin, so not much to report there in terms of actual portfolios here, but that's an interesting piece. And then finally, I wanted to touch on this because there's going to be a lot of headlines today, but the 30-year Treasury and the 20-year Treasury as well have touched 5% for the first time since last July. We've seen rates sell off pretty significantly, and that's going to sound like, man, this is just an absolute disaster, and bonds are getting killed, and man, Tom, you were so wrong on buying the 30-year at any point this year. And I will tell you, the bond math is very hard for people to wrap their heads around, but even though we've reached the highest level on the 30-year all year, and we've touched 5% for the first time in a long time, because we've been so tactical with it, even if we bought it on the first day of the year, the 30-year Treasury, because you start at such a high yield, and we've now burned off 5 of 7 months at a yield that was already 4.95, the 30-year Treasury year to date is only down 1%. The 20-year Treasury is only down 1%. The 10-year Treasury, which is like oh man, everybody, we got to be here. This is the safest place to be, is down 0.7%. So the difference is you're getting almost 1% more yield, which is going to offset any downside you see. Plus, your performance has been roughly the same. I mean, 40 basis points, and it's not like the whole portfolio is in 30-year bonds, but we're going to continue to look to target that. I mean, 5% for 30 years is better than nearly any bond you've been able to buy in the last 20. It's AAA, and the convexity is in your favor where you're amortizing off 5% because that's your yield every single year. So you're inoculated against bond volatility over time. And that's something that's really hard to wrap your head around. Bond math is very esoteric compared to stock math. And the 2-year year-to-date is up 0.25%. So it's like even if you were in the safest possible thing, you've only made 0.25%. You're not like absolutely crushing it. You're like, man, I bought short bonds. But everybody's buying short bonds, and there's not that much value there. And they've also sold off because now expectations are now that there will be no cuts, at least in terms of futures, which affects the actual trading of the bond market. So there's a lot of nuance there. But, I mean, think of it this way. The stock market has recovered quite a bit. We're now, nearing an all-time high. We're down a little bit yesterday, so we're not. Perhaps we could hit a new all-time today. But the effect is we're now overweight stocks. We can then rotate into some of these longer bonds, lock in for 5% for a long period of time, and you start raising the floor. And that's portfolio management 101 is stock market's hot, we trim back, we buy bonds. Guess what? Bonds are as cheap as they've been in over a year. Is that a good thing or a bad thing? The financial news media is going to tell you that's a horrible thing. This is the worst thing that's ever happened. But we can now average into some of those longer bond positions lower than they were. And guess what? Our yield over a long period of time goes up. And 5% is a real positive rate. Inflation, is somewhere between 2.5% and 3.5%. So you've got real gains over inflation at the current rates for a long time. And our expectation is that inflation will go down, at which point you'll have very real interest rates. I mean, you're outpacing inflation for the next 20 or 30 years on those bonds, and they're still a very small piece of the overall bond portfolio, but that's a real powerful thing. We didn't have positive rates for the longest time, and you were losing money to inflation. And so that's something to consider when thinking about, oh man, high rates is just going to crush everybody. Not if you got a lot of money. Not if you've got a lot of bonds. You can continue to just take that money, take very little credit risk, but take a large amount of duration and convexity and put it in your portfolio so that if rates do drop, you're going to end up with very high double-digit returns because that's how the bond math works. And so I guess I should clarify, this is not investment advice. Neither is buying GameStop. Please don't. I would say keep an eye on it because it's interesting, but don't buy it unless that's something you want to do. I wouldn't recommend it. But just be cognizant of that today where the whole story is not there. The story on GameStop is that this guy's nuts. He can't do it. The story is actually this guy's highly incentivized to the tune of billions of dollars. What would you do for $1 billion? Well, I might take a swing at trying to buy a much bigger company because that guarantees me $1 billion payout. Yields are really high. That's going to crush everybody. Not if you buy bonds. That's actually going to put you in a better position than anybody over the last 20 years. And so think of it that way. What's the real story here? And that's what we try and convey on this call. So as always, questions, concerns, worries, please reach out. I'm in the office today. The rest of the guys should be back later this week. I think TK is back tomorrow. So plenty of news coming out in the next 24 hours, and we will see you here at 8:30 tomorrow. Thanks.